My name is Darren Joseph from HTJ.tax, and we're the team that seeks to demystify the sometimes confusing world of international tax. And today we have the honor and privilege of having another conversation with Mark. Mark, could you introduce yourself?
I'm an advisor to the entire financial industry on CRS, FATCA, and CARF, and I've advised the OECD and the EU Parliament and the EU Commission and the German government, etc. All this is on my website for anybody to look at.
Fantastic. The first question today as we talk about CARF, what is CARF?
Okay, in one mem sentence, it's waiting for the submarine to move or surface. It's different to CRS, because in CRS, if you don't move with the assets, you're still going to be reported. But for CRS, you've got to move your crypto, whether it's selling it or moving it or transferring it to anybody. The background is the G20 instructed the OECD to introduce automatic exchange of information on crypto because everybody felt that tax evasion was happening with crypto because it wasn't being declared, and so they wanted to introduce reporting on it. The main way they did that is crypto assets are redefined as financial assets. Until now, crypto is not financial assets and therefore not subject to the CRS. So as CRS had been relatively successful to identify beneficial owners rather than legal owners, OECD decided to copy CRS. But there's two problems with copying CRS for digital assets. One is the digital asset industry operates completely different from conventional industry. Second of all, many governments haven't determined how to regulate a digital asset industry. So the architects of CARF needed to determine the different roles of different parties played before they could analogize those parties to a conventional FI. So for CRS, payment processing remains a backbone of the banking industry. The main revenue is from cash management and wealth management, and the non-digital financial industry entails the conversion of the means of payment into financial products that yield income streams. So relatively easy to capture with CRS. But in contrast, digital asset is rarely operated as a payment media, and digital currencies tend not to be exchanged for goods and services. The value of digital assets as an investment really depends on appreciation. Those people that kept their Bitcoin since 2010, they are billionaires today. As such, powerful incentive to hold the assets with a custodial bank to process income generated by income is missing from digital assets. And finally, keeping assets in a cold wallet appears to be safer than entrusting digital assets to a hot wallet or in an exchange. So accordingly, the digital asset reporting regime must rely on completely alternate sources of ownership information. So decentralization of the blockchain and the capacity to process transactions peer-to-peer, you can send it to everybody. On non-custodial wallets, digital assets are hidden away, not visible to tax authorities. So how do you identify beneficial owners of these assets? And it's like, as I said, hunting submarines. You wait for them to surface. So somebody who's been holding his Bitcoin since 2009, 10, it won't be reportable because it's just impossible to find. But as soon as they transact, that's when you'll capture them. And there'll always be transactions because somebody will die and then transfer it to their inheritors. So CARF is patient until you move.
Right. So in short, it's reporting digital assets at the point of transaction. So whether it be from crypto to crypto, crypto to fiat, or from person to person, that's when...
Crypto to crypto, yeah, it's just exchanging. You can go into Coinbase and say, sell my Bitcoin and buy Dodge. It's kept in your account, but that transaction is reportable.
Okay.